Welcome to The Deep Dive. We're the show that really tries to peel back the layers on complex stuff, find those key nuggets, and hopefully uncover some surprises for you along the way. Today, we're tackling something pretty fundamental in business. In finance, how do we actually know what something is worth, especially when you're staring at a company's financial statements? Sounds simple, maybe, but as we'll find out, value in finance is, well, it's rarely straightforward. We're focusing today on IFRS 13 fair value measurement. The standard, it came out back in May 2011. And look, it's not just boring accounting rules. It's really the bedrock for how financial assets, liabilities, how they get reported on balance sheets pretty much everywhere. It's about, transparency, consistency, making sure the numbers mean something comparable.
That's exactly it. Before IFRS 13, you had companies doing things all sorts of different ways. It was a real patchwork, made comparisons almost impossible, really. So the whole point of IFRS 13 and our deep dive today is to show you how it set up this single, clear framework. And importantly, it brought in these significant disclosure requirements. All of that is so that when you're looking at financial statements, you can actually get a better handle on how companies got to those valuations. It's about clarity, comparability, and hopefully trust.
Absolutely. And like you said, not just dry rules, it's about the assumptions hiding behind those often huge numbers in the reports. We're going to uncover some, I think, pretty surprising things about what fair value isn't and why that matters so much. So let's just dive right in. What exactly is fair value according to IFRS 13?
Okay, so the core definition, straight from the IASB, is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The absolute key phrase there, exit price. That's the crux of it. It's not what it cost you. It's not what you personally think it's worth to your specific company. No, it's about what the market would realistically pay for it or charge to take it off your hands right now. Historically, fair value meant different things to different people. IFRS 13 tries to nail that down. It's all about marketplace assumptions. It's not entity specific. So it looks at what buyers and sellers out there would consider. Things like, the asset's condition, maybe its location, any restrictions on selling it, market stuff.
Okay, so here's a scenario. Let's say a company owns, a plot of land. And they think the current market price is way too low. Our internal models say it's worth much more. Or maybe they just say, we're not selling to that price. So IFRS 13, let them just ignore the market reality then?
Good question. And that hits on a really critical point. The answer is no. IFRS 13 specifically prevents that kind of thinking from influencing the measurement. It hammers home that the price must come from an orderly transaction. And that's not just jargon. It forces companies to reflect what's actually happening in the market.
Okay, orderly transaction. What does that mean precisely? Are we talking like a desperate rushed sale or something more measured?
Definitely more measured. Think of it this way. An orderly transaction assumes the asset or liability has been exposed to the market for a reasonable amount of time before the valuation date. Enough time for normal marketing activities, drumming up interest. The whole idea is to ensure it's not a forced liquidation, not a fire sale where the seller is under duress and just takes whatever they can get. Because if it's forced, you don't get proper competition. Buyers might lowball. So orderly means time, marketing, competitive tension. Even if there aren't many transactions happening, a market can still be considered orderly if there's that competitive element, enough time, and good information out there.
Interesting. So if IFRS 13 is so specific about defining fair value, does it also tell companies what exactly they should be valuing? Like take shares. Should they value one share or a whole block of shares they own?
That's another really key distinction. And here's something important for you listening. IFRS 13 actually does not dictate the unit of account, meaning it doesn't say value the single share or value the block or value this group of assets. That decision, it's left to the other individual IFRS standards that deal with that specific asset or liability. And this leads to a really crucial aha moment, I think. IFRS 13 makes a very sharp distinction between a characteristic of the asset or liability itself, and a characteristic that only exists because a particular entity is holding it. Let's use that block of shares example. Say our company, Megacorp, holds a massive stake in some publicly traded company. If Megacorp tried to dump that entire block on the market at once, they'd probably have to accept a lower price per share, right? A block discount, because it floods the market. But that discount, IFRS 13 says that's a characteristic of Megacorp holding the large block. It's not an inherent characteristic of each individual share. Therefore, that block discount should not be factored into the fair value measurement of the individual share under IFRS 13. It's about the item itself, not the logistics of selling your specific holding.
Right. That makes a lot of sense. Okay. So we know what fair value is, this exit price idea and what not to include, like that block discount example.
Yeah.
But where does this hypothetical orderly transaction actually happen? What market are we assuming? Can companies just shop around for the best price?
No, not quite shop around. The standard says the transaction is assumed to happen in the principal market for that asset or liability. Or if there isn't one clearly dominant market, then it's the most advantageous market. The principal market is basically the one with the biggest volume, the most activity for that specific thing that the company can actually access. Usually it's pretty obvious. The most advantageous market, well, that's the one that gives you the best price after you factor in transaction costs and transport costs. So it maximizes what you'd receive for selling an asset or minimizes what you'd pay to transfer a liability once you net out those costs. Often they end up being the same market anyway.
And companies don't need to do some exhaustive global search for every possible market, do they? Just use what's reasonably available.
Exactly. Use all available info, but no need for an endless quest. Now, here's a really crucial point for you when you're reading those financial reports. Transaction costs, think broker fees, legal fees, stuff like that. While you use those costs to figure out which market is the most advantageous, you do not actually deduct them when calculating the fair value itself.
Oh, okay. Why?
Because fundamentally, those costs are seen as characteristics of the transaction, not of the asset or liability itself. The inherent value shouldn't change just because it costs something to sell it. The one slight exception is transport costs. If location is a key characteristic, say, getting bulky goods to a specific market, then those transport costs are adjusted into the market price to reflect the value in that market. And of course, the standard assumes your market participants are the usual suspects: independent, knowledgeable, able, and willing to transact, a proper arm's length deal.
Okay, this definitely sounds complex, especially getting the market right and excluding the right costs. So how do companies actually do the measurement? How do they arrive at this exit price, particularly if there isn't just a clear price tag sitting there?
Yeah, it can be complex in practice, but IFRS 13 provides a structure. It outlines various valuation techniques, but they generally fall into three broad buckets: the market approach, the income approach, and the cost approach. The absolute guiding principle, the North Star for all of this, is objectivity. You have to maximize the use of observable inputs, things you can see in the market, and minimize the use of unobservable inputs, things based on internal assumptions.
Right. And to enforce that principle, IFRS 13 sets up this famous fair value hierarchy, which is really key to understanding the reliability of these numbers, isn't it?
Absolutely critical. This hierarchy sorts the inputs used in valuation into three levels. Think of it as a pyramid, with the most reliable stuff at the top. Level 1 inputs. This is the gold standard. We're talking unadjusted quoted prices from active markets for identical assets or liabilities. Simplest example, a share price on the London Stock Exchange or the NYSE. If that price exists and the company can actually trade at that price on the measurement date, that's what you use, period. No fiddling. And an active market just means there's enough trading, enough volume happening regularly to provide reliable prices.
Okay, but what if that level 1 price just feels wrong? Say some massive news breaks right after the market closes, a huge merger or a disaster. Is the company stuck using that now stale closing price?
Good practical point. There is a bit of leeway there. The standard does say an alternative method can be used if that quoted price doesn't actually represent fair value at the measurement date. So your example is perfect. A significant event happens after market close, but before the reporting date, maybe a major restructuring gets announced. Using the closing price wouldn't make sense. It wouldn't reflect the current reality. So yes, they could potentially adjust or use another method in that specific case. Okay, moving down. Level 2 inputs. These are inputs other than those level 1 prices, but they are still observable, either directly or indirectly. Think quoted prices for similar assets in active markets. Or maybe quoted prices for identical assets, but in markets that aren't considered active. It also includes things like interest rates, yield curves, credit spreads data you can essentially pull from market sources. You might need to make some adjustments with level 2 inputs, perhaps based on differences between the item being valued and the observable data point. And here's an important detail. If you need to make a significant adjustment to a level 2 input, and that adjustment itself uses unobservable data, then the whole valuation might get pushed down into level 3.
Okay. So that brings us to the bottom level.
Level 3 inputs, right? These are the unobservable inputs. You only use these when you can't get reliable level 1 or level 2 inputs. The principle is still the same. Maximize observable, minimize unobservable. But when you use level 3, the inputs must still reflect assumptions that market participants would use. It can't just be wishful thinking from the company.
So unobservable. Does that mean a company can essentially use its own internal data, like its own projections?
Yes, it can. IFRS 13 doesn't stop a company using its own data, say, its own cash flow forecasts for valuing a private subsidiary they own. But, and this is a big but, that data has to be developed using assumptions that are consistent with what external market participants would reasonably use. You can't just invent wildly optimistic forecasts that nobody else would believe. And the key rule for classifying the entire fair value measurement, it gets slotted into the hierarchy based on the lowest level input that is significant to the whole valuation. So even if 90% of your inputs are level 2, but one crucial assumption is level 3 and it has a big impact, the whole thing is labeled level 3.
That hierarchy really clarifies the reliance on judgment, doesn't it? Level 1 is pretty objective, level 3 much less so. Okay, that makes sense for financial stuff. But what about, say, non-financial assets, buildings, machinery, or even liabilities, which seem inherently tricky to value? How does the standard handle those?
Good question. Yeah, they have some specific wrinkles. For non-financial assets only so, your property, plant, equipment, intangibles fair value is based on their highest and best use from a market participant's perspective. This means you have to think, how would someone else in the market use this asset to get the maximum value out of it? Maybe they'd use it differently than the company currently is. Maybe combine it with other assets. And this highest and best use has to be physically possible, legally permissible, and importantly, financially feasible, meaning it has to generate a return that market participants would demand for that kind of investment. So going back to that plot of land example, even if Megacorp uses it for, say, a parking lot, if market participants see its highest and best use as building luxury apartments, that's the potential use that should inform its fair value.
Even if Megacorp has no intention of building apartments.
Even then, it's about the market's perspective on the asset's potential, not the current owner's plans.
Okay. And liabilities.
Yeah.
And the company's own equity.
Right. For liabilities and the company's own equity instruments, the idea is you're assuming they're transferred to a market participant at the measurement date. Now, often there isn't an active market for transferring liabilities, obviously, and that highest and best use concept, it doesn't apply here. So the valuation is often done from the perspective of the party holding the corresponding asset. If there isn't a direct corresponding asset, think of something like a provision for cleaning up environmental damage, you'd use appropriate valuation techniques. But here's a really critical, maybe counterintuitive point for liabilities. Their fair value must reflect non-performance risk.
Non-performance risk.
Meaning the risk that the company won't actually fulfill the obligation. Essentially, it includes the effect of the company's own credit risk. So if Megacorp owes a bondholder $1 million, but Megacorp's credit rating is terrible, the fair value of that liability on Megacorp's books is actually less than $1 million. Why? Because a market participant taking over that liability would demand compensation for the risk that Megacorp might default. So the company's own poor credit standing reduces the carrying value of its debt from a fair value perspective.
Wow. Okay. That's definitely something to keep in mind. It also really highlights that the price you initially paid for an asset or received for taking on a liability, that's the entry price. Fair value is the exit price. They aren't always the same, are they?
Not at all. Conceptually different. And because there can be so much judgment involved, especially with level 2 and level 3, transparency is paramount. That's why IFRS 13 brought in much tougher disclosure rules. Companies have to tell you which level of the hierarchy each fair value measurement falls into level 1, 2, or 3. They need to disclose if things move between level 1 and 2. They have to explain the valuation techniques and the key inputs they used, and any changes in those techniques. And for level 3, the most subjective ones, they need to provide even more detail, like a reconciliation showing how the balance changed during the year, plus quantitative info about those significant unobservable inputs and assumptions. The whole point of these disclosures goes back to the start. It's to allow you, the user of the financial statements, to better assess the valuations, to understand the inputs, the judgments, the potential variability. It pulls back the curtain.
So quite a journey there. We've gone from defining fair value, that exit price in an orderly transaction, through figuring out the right market, navigating those tricky assumptions, and then really digging into that 3-level hierarchy for actually measuring it, plus those special rules for things like factories or liabilities reflecting credit risk.
Yeah, and if you step back and look at the bigger picture, standards like IFRS 13, they're not just technical exercises for accountants, not at all. They're really fundamental tools for creating consistency, comparability, and hopefully transparency in financial reporting across the globe. The goal is less ambiguity, more trust in the numbers that companies publish, giving you a clearer view of what's really going on.
So what does this all mean for you listening right now? Well, the next time you're looking at a company's annual report, especially those footnotes about fair value, you now have, I think, a much more sophisticated lens to view those numbers. You understand the process, the assumptions, the hierarchy. Which brings up maybe a final thought. Knowing all this, knowing that value is based on this hypothetical exit price today in the market, what new questions does that make you want to ask? Perhaps about a company's reported asset values, or maybe how vulnerable they might be if market conditions change suddenly.
That's a great point. And these principles, they might even echo in how you think about value more broadly, like the value of your own house or investments, and often comes back to what someone else, the market, would be willing to pay for it, right?
A powerful connection indeed. That's all the time we have for this deep dive. Thanks for joining us. Keep asking questions. Stay curious.